Hi, everyone. I'm Mike Pacito with IM Global Partner. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. We believe with DBMF, we have designed the ideal solution for accessing the managed futures category by combining an index plus replication approach and low fees in an elegant, efficient, and effective ETF. I'm joined by Andrew Beer, co-founder of Dynamic Beta Investments and co-portfolio manager. As usual, we'll be touching on recent performance, macro commentary, and current positioning in the strategy. And this month, we'll also be tackling short-term underperformance head-on and contrasting that to what we believe is a relatively anomalous period versus the long-term story. Let's get to it, Andrew. I'm going to hand it off here to you.
Thanks, Mike. So we were up in May, but still trailed both the SGCTA index, here and after the hedge fund index, and Morningstar US trend systematic category, here and after the Morningstar category. To cut to the chase, we obviously are frustrated with year-to-date performance relative to hedge funds and mutual funds. What we've seen this year is a 3 sigma event. The replication model is working, and in fact, our correlations have remained at normal historical levels all year. However, our particular factor set has underperformed several months in a row. It's the statistical equivalent of flipping 5 or 6 tails in a row. It's unlikely, but it happens, and it doesn't mean the coin is broken. So we expect our performance relative to the indices shown to revert to what it's done in the past, potentially outperform through fee disintermediation with high correlation. We'll walk you through all this in a few slides. On the macro front, make no mistake, this is a one-trade market. Every market is reacting to whether the Fed will keep tightening or not. 1 month, everyone thinks we've hit peak rates, and this reverberates across asset classes. The next month, we're back to sticky inflation, and the ripple effects start all over. So the macro crystal ball is particularly blurry these days, what some hedge funds have called a very weird, quote unquote, market. By the end of March, people were calling for a hard recession in a matter of weeks, no more. The Fed is draining liquidity from some parts of the system while pumping it into others. So like a drunk stumbling across a highway, we keep watching these macro near misses. Regional banks are still standing and still lending. Profits haven't collapsed. Unemployment hasn't soared. And the geopolitical backdrop, while scary, hasn't deteriorated. And price moves, not fundamentals, keep driving the market narrative, with breathless stories about unprecedented this or unprecedented that. So from our perch, it feels like the broad markets will break in one direction at some point soon, which should produce durable trends across the major markets we trade. Given this market uncertainty, we see a portfolio today with positions that can perform in different markets. We're long gold, probably a good place to be if inflation remains high. Conversely, we're short oil, perhaps a hedge if that deep recession hits. We remain short the 2-year treasury, which looks like it's the right place today. Equity positioning keeps moving around, not surprisingly, given the market short gyrations, and we're long EFA and the S&P against emerging markets. But we wouldn't read too much into it from a fundamental perspective. Lastly, we've once again have a big short to the Japanese yen, so let's all hope for a repeat of 2022 when this was our single biggest moneymaker. Now let's move to the next slide. Here's our usual slide since inception versus the S&P 500 and Bloomberg Ag, titled Diversification Bang for the Buck, quote unquote. Tons of alpha versus both stocks and bonds, even with limited time since inception in 2019. Hence, this explains our constant refrain about why managed futures should be a strategic allocation in every diversified portfolio. The evidence over decades is compelling. For our ETF model friends out there, we note that the entire managed futures ETF space is 0.02% of all assets, and we're half that. So clearly, we're going to try to change that over the next decade with a lot of education. Next slide, please. And here's our usual slide with performance since inception against both the SocGen CTA Hedge Fund Index and Morningstar US Systematic Trend category. It's important to frame this frustrating year in a broader context. DBMF has outperformed both the index and the Morningstar category since inception with a correlation of around 90% in an ETF with an expense ratio of 0.85. For professional investors, we encourage you to evaluate related performance back to 2016 if you've not done so already. One important stat is that DBMF has outperformed the Morningstar category space by 340 basis points since inception. Another important stat, which isn't on this page, is that while you as an allocator are looking at the mutual funds and ETFs today, you're staring at a highly curated group of guys who, on average, have done a lot better than the index. So how could this be? Because firms aggressively shoot the wounded and hide the bodies. When we launched the strategy underlying DBMF in 2016, there were 49 mutual funds and ETFs in the Morningstar category. 30 of them have been closed, many run by top-tier firms. Those funds that have done better recently get marketing dollars and show up in your inbox. So the challenge is how to see through the fog of hot dot sales. Now, feel free to reach out to me if you want to get data or discuss any of this further. Next slide, please. Now let's get to the meat of what we want to discuss today. Despite underperformance this year, the replication model is working as expected. The chart on the left plots monthly returns over the past 12 months against the hedge fund index. Clearly, we are pointing in the same direction. When they go up, we go up. When they go down, we go down. For the statistically inclined, our correlation is 0.8887. Now look at the two colors of these dots. The 2022 dots tend to be above the trend line, while the 2023 dots are consistently below it. So we expect monthly variations. Replication is an estimation, a synthesis. And so we do expect month-to-month noise. Over time, the noise tends to be random. We outperform one month, give back a little the next, et cetera, and it smooths out over time. When you cut out fees and expenses, you get what's called upward drift, quote unquote. A year later, we tend to outperform the vast majority of the time. Every now and then, just like flipping coins, you can get either several heads, which is great, or tails in a row, which is frustrating. And that's what's happened this year, several tails in a row. So how unusual is that? Very. The chart on the right shows the rolling 6-month performance of DBMF since inception in 2019 versus the hedge fund index. The current 6-month underperformance is the worst we've ever seen, a 3 sigma event, which equates to around a 1 in 100 chance of happening. So this can happen, but it's very rare. Note that there are also plenty of examples where we keep flipping heads and the noise plays in our favor. And if you look at it over longer periods, both related and hypo numbers, this period is definitely unusual, but certainly not unprecedented. So by the way, if you're statistically nerdy, you'll note that distribution is leptokurtotic, which is a very, very cool way of saying that you tend to outperform more than you underperform. Hence, we conclude that underperformance might be temporary, and DBMF has the potential to get back to the pattern of outperformance we've seen through fee disintermediation. That is the cornerstone of our approach. Next slide, please. To go one step deeper, here's a little research project that blows up some myths about diversification and CTAs. Ask yourself, what is the one trade that is driving dozens of markets this year? The Fed and inflation. And the instrument most sensitive to it is the 2-year Treasury. The chart on the right shows a replication model using only the 2-year Treasury, literally only a single factor. So every Monday, you run a regression that says, to mimic the recent performance of a diversified basket of large CTAs, each of whom trades dozens and dozens of futures contracts, you'd want to be X% short the 2-year Treasury. Then you short the Treasury future in the same weight and go home till next week. Magically, you would match the performance of the hedge fund index with a correlation well above 90%. Now look at the line that underperforms. When you add exposure to major currencies, equities, and commodities, ordinarily helpful sources of diversification, performance gets worse. Your correlation does remain high, not as high, but you can see this grinding underperformance, the succession of tails that we see in DBMF. Now turn to the chart on the left. Over a longer period of time, trying to replicate the hedge fund index with a single factor is a terrible idea. We know that, and everyone in the space agrees with us. A four-factor model, by contrast, just the 2-year Treasury, S&P 500, crude oil, and dollar index, not only can replicate the index with a high correlation, but also can materially outperform through fee and expense disintermediation. And so this was the aha, quote unquote, moment that we had back in 2015. So we eventually expanded our factor set to pick up 10 or more major markets, but this notion that you need 70 instruments to achieve diversification is generally a fallacy. So what's going on? On the research side, we also run our own simple trend volume models to see what positioning looks like. It's a good reality check on our factor models. And what we see is really interesting. Some of the most valuable positions this year actually are highly correlated to the 2-year Treasury. Rather than offer diversification, the positions will result in a doubling up of risk in the 2-year, hence look more like the unconstrained 2-year model we just discussed. To be fair, some other futures outside our factor set, such as certain minor market commodities, have also contributed to performance. But the biggie is the 2-year, the one trade market. On our end, the combination of a focus on major markets plus some constraints in the regulatory limits on what 40 Act funds can invest in, limits on illiquid securities and commodities, means we've been pointing in the same direction, but not picking up the same magnitude of performance. So back to where we started. This is all incredibly unusual. We understand what is going on. We're not worried, and we think that we'll soon look back on this period as highly, highly atypical. Next slide, please. Here's our standard chart on volatility-adjusted positioning. The big shifts over the past month are a move to a significant short position in crude oil, a buildup in the short position in the Japanese yen, a compression of a spread trade between EFA and the S&P 500, which more recently went positive, plus an increase in the short position in emerging market equities. We remain long gold and short the front end and back of the treasury curve, but have flipped to modest long in the 10-year. Taken together, this looks like a portfolio that might benefit from a recession or stagflation. So with that, I'll hand the baton back to Mike.
Thanks, Andrew. I opened by describing DBMF as elegant, efficient, and effective. This slide tells that story very simply, showcasing the since inception performance of DBMF versus the category average as defined by Morningstar. And while it's not all about fees, Jack Bogle proved convincingly that they certainly matter. In fact, they matter a lot, especially in the managed futures category. The simple notion is one of the mottos of dynamic beta, that fee reduction is the purest form of alpha, and it's a key characteristic of what makes DBMF unique and compelling. So I'll close here with this by saying thanks to all of our clients and to our prospective clients for your confidence and interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com. Until next time, from DBI and from iMGP, thanks for spending time with us.